Hello, everyone, and welcome to this week's podcast. We are actually recording this on January the 19th, but this podcast will be released on the 20th. And today we're seeing most indices move lower. It's been somewhat of an interesting week, but it's not been a week without action to pay attention to by any means. It's not had a lack of things to watch or lack of things that has occurred this week, anyways.
Yeah, for sure. And earnings season does that. It gives us something to talk about. It gives us some catalysts maybe in the equity markets, as Joseph and I talked about a couple of weeks ago. And then last week we talked about international commodities. Plenty to talk about. Earnings, like I said, maybe given some type of direction there, one way or the other.
Well, and on the international front, we've now seen international equities move up to the number one spot. It was last Friday, I believe, and it gotten to within one buy signal of cash, and then
he's talking about Dolly,
right? Within Dolly. So international equities moving up to that number one position for the first time since May of 2010.
Yep.
So really, almost coming on 13 years that it's been. And that also, I believe, was the last time that international had ranked above domestic as well, if I'm not mistaken. So, this is an environment that, as far as international equities, that we haven't experienced in a while. But we have also been hitting a lot on international equities here recently, mainly because for the past 3 weeks or so, it's been about the only thing to talk about. So we're going to shift gears a little bit this week and talk about within the domestic equity space a little bit more in detail, if you will. The one major thing that I feel like we should probably mention before we get into the details, sort of diving into some sectors, is we did see the money market percentile rank fall below 20th percentile for the first time since, I believe, August of last year. It technically fell to this reading of 18.31% for about a day in August, but then ultimately increased. So we're kind of on that threshold. So we're seeing if equities can finally have that another oomph, if you will, at this point, as far as the indexes, looking at resistance levels, as far as indicators, looking at prior levels that were high. So it's almost like domestic equities needs that last oomph. And we've seen some sectors starting to show some signs of giving that potential oomph, but there's a lot to still keep an eye on this week.
Yeah, and we're going to keep our discussion around sectors. I think if you listen to a podcast, read our report, you know what we think about international, even just broadly domestic equities. I think we've been pretty clear there about our preference toward value, equal weighted exposure still at this time. But I think some of the sectors, I know David had a couple, I had a couple that have caught my eye. So we're going to hop into those this week. David, you want me to start, or you want to start with your sectors?
Go for it.
Me start. All right. I'm going to start talking about real estate to begin. So real estate equity sector,
which isn't a sector that you've probably heard much out of here recently.
Yeah, you probably haven't heard us talk about it because it's been a laggard for quite some time now. I believe since the middle of 2022, it's been in the bottom half of our Dolly sector rankings. So those are relative strength based, which essentially means that they've performed very poorly relative to other sectors on a price performance basis. A lot of the headwinds that come for the real estate sector you can trace to interest rates, where velocity of rising interest rates is typically not helpful to the real estate sector. Keyword being velocity of rising interest rates, not just necessarily rising rates, but the pace at which they're going up can be very harmful for the sector. They're second to last in our sector ranks right now. And some technical points that I want to highlight. First, just on performance. So over the past 30 days, although they are second to last in the Dolly ranks, real estate, XLRE, proxied here by the fund, is the second best performing of major sectors. And really, if you look at timeframes around that, it's near the upper half of the sector performance. So you've seen a pretty good amount of participation in the real estate sector, despite being a laggard. I think some of the indicators that I could point to there, one is going to be the 10-week for the real estate sector. That's the percentage of real estate stocks above their 50-day moving average. That recently hit 74%, which was just 4% lower than the August highs of 2022 and around the March highs of 2022 as well. So you saw a similar type of thrust from the real estate sector. That reversed down yesterday, down to 68%, but still in high field position. That's a lot of stocks within a laggard sector above their 50-day moving average.
Well, and somewhat of our discussion too, I feel like folks are going to hear the word laggard a lot. I mean, because the sector I'm getting ready to talk about is going to be consumer cyclical, or discretionary rather. Both real estate and discretionary within Dolly sit very low in the rankings.
Yeah.
But near term, we've seen this really good bounce out of it. We've also started to see some of, like you said, within the 10-week average or 10-week moving for high levels for real estate. For consumer cyclical, the thing that was interesting to me is not only have you seen positive BP action there as well on the PT chart for the broader, consumer cyclical space, but you've also seen some of these RS and X's charts, which measure the percent of stocks within the universe that are in a column of X's on their market RS chart. Or said another way, this percentage of stocks are exhibiting near-term outperformance over the market as defined by the S&P 500 equal weighted index. So when you're looking at an elevated percentage, that just means there's more stocks moving and showing the ability to outperform the S&P equal weighted index. And we've seen some of these others move, back into a column of X's and even move to relatively high levels. Another sector I'll talk about, not as surprising to see it at a high level, but seeing that RS and X's for consumer cyclical, that symbol being caret RSXEC con CON CYC. It's a mouthful. Anyways, it has rallied up to the 58% level on its chart, which is the highest level it's seen since March of 2021.
We'll put the charts on YouTube. You don't have
you don't have to
that.
find it.
Yeah.
But just for your own information, that symbol is rather extensive. But seeing that indicator move up to its highest level since March of 2021, almost 2 years, that it's really it's almost gone. It was more than a year that it went being below the 50% level. So really suggesting that even less than half the stocks were exhibiting the ability to show near-term outperformance versus the S&P equal weight. Now that has changed. We've seen that indicator increase. Now we've not so much seen relative to other sectors, consumer cyclical pickup signals, but this is one of those first things that's at least a silver lining, if you will. For something that's been beaten down for so long, you're starting to see it maybe give some signs of life, if you will. And I mean, to me, there's at least a couple of options. There's some diamonds in the rough. There's not complete shanks out there that you can look at. But I'll get
before you get to
those.
Later. Before we get some ideas, I reiterate too that it's not uncommon to see these laggard sectors. So sectors that have performed very poorly, you get these big thrusts and these big bounces from them during market environments like this. Like you saw March, you saw June, you had August, where you saw some type of laggard thrusts from these sectors. Maybe not to the same extent as we've seen them now, but we've seen it before. Something about the 10 weeks that I wanted to add as well. So those 50-day moving averages, keep in mind they're a moving average. So as you're taking off those earlier points in the calculation, your 50-day moving average may be going lower, which in turn gives you a lower hurdle to jump. So sectors going down, that 50-day moving average, or that bar to jump over, is also going lower and lower and lower. So when you get these sectors that get beat up, they pick up a lot of volatility, and they can kind of harness that when you get a bounce or a market rally, as we kind of saw into the year, beginning of this year. They can quickly hop up above those 50 days.
As a random sidebar, thinking about a good example of that in an index that I was looking at here recently, you could look at the chart of the Russell 2000, because it moved up above its 200-day moving average here recently. But looking just at that moving average chart, it would be a good example to see the mechanics of how a moving average falls, and then as price increases, you can start begin to hurdling over those. And that overall, how you can begin to see price increase, but a moving average still continue lower because the average is lower than current price. But that's a digression. We'll get back to our original programming at hand here. But the interesting piece is we're talking about these laggards. There's been one sector, at least, that from a relative leadership standpoint, that has kind of bucked the trend and participated in this rally along with the laggards. And that's been basic materials. I mean, similarly, basic materials on that RS indexes chart measuring those, stocks showing near-term outperformance is hitting its highest level really since, early 2022. We've also seen basic materials move up into the number 2 position. The fund score for the group moved above 4 this week on the asset class group scores page. So it's really maintained, while you maybe have seen energy hit a little bit of chop. Banks have had a pretty rough go of it in the past week.
Some have, yes.
And some that's the thing, is you've seen some of these other leadership areas begin to, I guess, have some spit and sputtering, if you will. Basic materials hasn't done that yet. So it's really been able to participate with a lot, and really is I wouldn't say all in a class on its own, but definitely has done things that leaders haven't been able to do here recently. And it's one that, you've seen some of our models maintain the exposure or pick it up since, late last year. Others haven't, and some have traded in and out of it. But it's been a sector that I feel like in some ways has quietly been showing its leadership ability, while, many or other are catching the headlines. And some would say the reason you've seen a big improvement is it's also been helped out some by, rates. There's some correlation with obviously this sector and looking at precious metals, and you've seen some of those precious metals rally. So you've seen definitely some breadth to not only upside, but that breadth of participation within the material sector. So it's been one that's been able to buck the trend a little bit, whereas recent leaders have hit some starts and fits. It's held its own, if you will, and has shown some ability, like I said, to move into X's on these charts, continue to doing so. We actually saw it continue to increase with yesterday's action, so indicating that more and more charts are moving into X's, showing that the near-term outperformance over the market. So basic materials is one to, if you don't have exposure, probably should at this point. It's definitely giving you enough evidence to warrant its inclusion in a portfolio.
Yeah, it's in second in our ranking, so it's a clear overweight for us still. Real estate, to be clear, as I led with, has some good participation still towards the basement, so it's still going to be an underweight for us. And really, actually, if you look at a fund like XLRE, that's a good picture of that. You've seen a ton of participation from the sector, but it still has not been able to break back into a positive trend. So it's on a sell signal. So I think it's important it's really tough to distinguish. You get a big rally, you get a ton of participation for a sector. Is this a selling opportunity? Is it actually your sell on rally opportunity, or is it the start of something new? So the weight of the evidence for like real estate right now is that this looks like a sell on rally opportunity. You saw a ton of breadth, a ton of participation, but you're not seeing a lot of follow through on your major, at least kind of passive real estate indices failing to break out of their positive trend lines. So that may be a more sell on rally opportunity. Whereas something like basic materials sits second in the rankings. It's been a good performer. That's something that if you see these breadth thrusts, if you actually get a pullback in the sector, maybe that's something to add on versus sell on rally.
Right.
So that's an important distinction as well. When you were talking about basic materials, we kind of started with some of the laggards and then basic materials doing well. Another one that's been pretty steady has been industrials. It's been equal weight in our rankings for a while, kind of middle of the pack in the Dolly setup. It hasn't been sparkly per se. It's not a sector that's going to have an incredible week or a horrible week, really across any time horizon. I was looking up 7 days, 30 days, 2 months, 3 months, whatever time frame. It's just been hanging in the middle of the pack.
It's never the worst, but it's never the best.
It's never the worst and never the best. You can look at some of the charts, and that gives a good story of it, like XLI, your broad sector fund. It's actually hanging around its all-time chart highs, which are around 106. It's currently at 102, formed a double top, which is above the August 22 highs. I would note it may be in jeopardy of reversing down today, but really just hanging around. And that's been a pretty good place to be, at least relatively speaking. Some individual names within industrials. I want to highlight that Caterpillar finally reversed down on its chart. That's one of the biggest column of X's I've ever seen. But 4 attribute stock still looks really strong within the industrial space. Deere's another one that's also hanging around. It's all-time chart high. So it's not necessarily something that's like I said, making headlines, but it's been pretty steady.
Well, and it's interesting that we're both talking about basic materials and industrials because sometimes they can have
There's some
a
linkage,
bit
yeah.
of a crossover. Because one of the names that I was looking at within basic materials actually falls within our chemical sector, which you could almost kind of toss it in between the two, with basic materials or being industrial, being in the chemical sector. But it's DuPont. So DD, it's 3 for 5, ranks in the top third of the sector matrix there. Moved back into a column of X's against the market earlier this month. Still maintains a buy signal while a lot of charts have pulled back, into a column of O's, still in a column of X's, although might show the potential to move into a column of O's today. But, 3 consecutive buy signals, is now trading at levels that it's not seen since March of last year. I mean, those aren't things that many stocks in the market period can say. So it's one that I think is quietly kind of become, at least now, come onto my radar for sure. But has been one that, really has shown notable improvement since October. And, elsewhere within at least basic materials, Commercial Metals Corporation, CMC, is the top ranked stock in the steel and iron sector matrix. Hard to argue with that. It's really been maintaining a lot of its relative improvements since 2021. So and now granted, the reason it's probably done that is it's a small cap name, so it doesn't really get the headlines within the space. But 4 consecutive buy signals, pulling back here with yesterday's action, right back to the middle of the trading band. Can't argue with that technical picture too much. It's a pretty nice looking one. So CMC and DuPont DD, I mean, those are 2 names that strong technical pictures are seeing strong strength out of those sectors. If you're looking for something, after we've been in a year where it felt like you were trying to grab for straws at times for things to invest in, here's a couple of stocks that, and you've mentioned a few too, that they give us at least a little bit of opportunity to put some money to work.
Yeah. I'll circle back and just throw out a couple for real estate as well. I realized I didn't do that before, but CBRE is another one. That's the ticker symbol and also part of the name of the company, CBRE Group. Or attribute, a nice pullback today, actually beneath the August highs, but within the space looks pretty strong. Simon Property Group is another one within real estate. Hard to ignore. Bullish catapult recently, kind of reversing this really long-term downtrend. I think maybe something too we're hinting at is that we may get into an environment where it's better for stock picking. For a while, that was just not the case. You had to buy the index, buy big cap tech, and own more of it. But now there's a lot of opportunities within sectors to be active, to take some individual plays. So maybe we stay in a stock pickers market for the rest of the year.
Yeah, it might be. But we've also, we're seeing things to start this year that it feels like we're saying it again that we haven't seen happen in a decade. So this is restarting old saying, I guess, or maybe it's not old because we've been doing it for 12 months. But it's a year in which we have something we haven't seen in a decade. Plus, with international equities, can't be ignored. But like we're talking about too, it's not like there isn't some potential. Well, for lack of a better phrase, diamonds in the rough elsewhere within domestic equities within the market. So it may be sort of an intermediate, shorter term focus, but right now that's sort of where the market is pointing to us. This is what's happened here recently. So
if you want some more commentary on sectors, I know we hopped back and forth today. But if you want a more direct commentary, we do put out this weekly analyst discussion every Wednesday afternoon on our platform where we all spend probably about 3 to 5 minutes just running straight through a sector, some of the indicators and stocks we like. That's on the resources tab. You can also find it on the daily equity report. So if you want more sector stuff, kind of like what Dave and I were going back and forth with today, make sure to check that out. Again, if you want to know what we think about international, you can just check out the report, listen to podcasts.
It's probably been in every article.
Yeah. Well, cool. I don't have anything else. Do you have any of the tabs?
Nada.
Cool. Well, appreciate you being in person today. It's fun to do it.
Not a problem.
In the office. Thanks. Yeah. Thanks everybody for listening. We will be back online next week.